Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by European rate specialist Joann Spadigam.
All right, Imogen, let's start with you today. In the UK, there's been lots of central banks speak in an otherwise quiet data week. So did we learn anything new this week?
I guess in short, the answer is no. We've heard from lots of central bank speakers, probably the highlight being Bailey and others in front of the Treasury Select Committee. We've heard from Dingra, the leading dove on the committee, and we've also heard a couple of times from Megan Green. The message I think that we're really hearing from the centrist members of the MPC, those that voted for a hold and would have to switch their vote for a cut in order for policy to be eased, was that the data is tracking and trending in the right direction, but we still need to see more evidence of it. I don't think that the message has changed at all. From what we heard in front of at the MPC, at the press conference a couple of weeks ago. There was lots of excited headlines this week about Bailey saying that inflation didn't need to get back to 2% for the Bank of England to cut rates. Which of course is exactly what he said at the press conference. I'm a little bit confused why we all got so excited about it. And of course, it's exactly what Pill has said previously too. And others have also alluded to this fact that, rates are at such restrictive levels now that they can still be cut and the policy will still be restrictive. So I think it's important not to kind of get too overexcited about any one thing that any of them say when it's no different to what we've been hearing over the last couple of weeks. Perhaps what was more interesting was the market reaction, and that kind of triggered a somewhat sizable rally. And I think that that's probably still indicative of the fact that there is an appetite to be long front end, especially in the UK. I think we've had a big washout with the market moves that we've had over the last couple of weeks in terms of positioning. And although the current profile of market pricing looks relatively hawkish compared to where we have been just a couple of weeks ago, I would say that maybe that isn't necessarily indicative of what is actually underlying consensus, and more just an indication of how positioning has had to shift over the last couple of weeks. And perhaps there's a little bit of dry powder still on the sidelines for investors that are still looking for opportunities to go long at the front end of the UK. One final thing that I did think was semi-interesting, I suppose, and maybe clutching at straws a little bit from this week's BOE speak, was just a comment by Swati Dingra, the BOE's leading dove, of course, the only MPC member to have voted for a cut. And she has been a dovish dissenter on the MPC for many meetings now. But she was asked at her M&I Connect webinar, what she would be looking for in order to vote for 50 basis point cuts rather than 25. And I thought it was interesting that she sort of, didn't have a clear framework in the way that she would think. She clearly hadn't thought about the possibility that they might need to cut in 50 bit increments yet. Of course, a lot can change between now and when we think the first cut might be, which is in August. And the longer that they keep rates at this higher level, perhaps the more likely it becomes that they have to cut in bigger increments. But it was an interesting message, I think, from the leading dove that 50 basis points aren't really on her radar right now, which I think goes without saying that it's not on anybody else's either.
The other thing that markets are starting to look forward to now is the budget as well, and with headlines this week around the fiscal headroom there, and potential for tax cuts. So what are your early thoughts on this?
Yeah, I think the budget will definitely come back to in more detail next week when we finalise properly all of our numbers in terms of what we're expecting for fiscal policy announcements and what that means in terms of the gilt remit. But I guess just my high level takeaway this week in terms of the narrative around how much headroom there will or won't be for tax cuts. From a market's perspective, it's almost somewhat irrelevant. The more fiscal headroom that the OBR projects for the government, the more that they will recycle that into pre-election kind of fiscal giveaways. And so in terms of, the issuance outlook, it really doesn't change all that much. If they have more headroom, they will just use up more of that into tax cuts or national insurance cuts, for example. Whereas if they don't, because they can't find as enough in terms of spending cuts in future years, then they won't. But the issuance outlook is broadly the same, in all the different estimates of what headroom there is or there isn't. We're talking only a kind of couple billion different, which when the kind of gross funding needs next year might be in the region of 270, 280 billion. A couple billion here or there, I don't think moves the needle in terms of the market reaction. The message or the takeaway for markets is that we're still in a period of sustained and very high supply. And this budget, I don't think there's going to be enough to move the needle on that. Of course, this government will want to look fiscally responsive, so they won't use up all of whatever that available headroom is, but they will use up the vast majority of that. In terms of how else it might influence the market, I'll be watching two things. First of all, what that degree of fiscal easing is, because of course that will limit potentially the extent to which we may or may not see earlier bank rate cuts this year. The easing that was announced in the autumn statement back in November is probably larger than what the government will have headroom to announce in the next couple of weeks, we think. And back then, the BOE judged that to have quite a small inflationary impact. So I don't think that this changes all that much for your kind of base case scenario with how you're thinking about the BOE. And perhaps more interesting then than the overall supply number, which we still expect to be very high, than the fiscal easing, which we expect some degree of, but not enough to move the needle for the BOE, is the skew of issuance and how that is, how the DMOs shift their issuance kind of across the curve. I think it's broad consensus now that we see a shift shorter in duration of issuance, so they proportionally increase the shorts and proportionally decrease the longs and the linker buckets. But I think that's broadly consensus now. I think some degree of the cross-market flattening that we've seen in the UK and the swap spread curve flattening as well has been related to this expectation or pricing in of the fact that we think the DMO will shift issuance shorter. And I would probably just caution against expecting too much of a shift, because the overall gross issuance number is likely to be so high that it's difficult for the DMO to be particularly kind of nuanced or nimble. And of course, even if they proportionally decrease longs and linkers of a very high number, that still results in a high amount of issuance in kind of sterling billion nominal terms.
So thinking about issuance again, I mean, we've also seen some headlines on that, on the UK DMO potentially following in the footsteps of European governments as well, and making gilts more readily available to UK investors. So how does that change your view on the demand and supply imbalance we're seeing in the UK?
Yeah, this has been a kind of recurring theme, I would say, over the last 18 months. Certainly it feels like every meeting that we go to, there's someone in the finance community that's asking me why more people aren't buying gilts given their kind of capital gains tax free. And for a long time we're yielding, well, still are, although off the highs, at very high yields, which was more competitive often than what was being offered in other savings and investment vehicles. Part of the reason, and this has always been what I've kind of said in response to that, is just that I think there are still quite high barriers to entry to retail investment in gilts. It's not like what we see from Italy, for example, with specific retail bonds that are targeted at retail investors and easy for them to buy. It's not the same in the UK. There is no specific retail gilt, and there are high barriers to entry. You have to have a broker account, you have to know what a gilt is and how to buy one, etc., etc. And so although we have seen a very big pickup in retail demand for gilts, that's been from a very low base, and it still makes up, I think, a very small proportion of overall gilt demand. But one of the follow-on question has always been, why don't the DMO make it easier for retail investors? Why isn't there some kind of retail specific product? And this week they have seemingly made the first step towards doing that by allowing retail investors to participate in primary auctions, so in supply events, rather than just being able to buy them on the secondary market. So they've kind of taken one step towards becoming a bit more retail friendly, if you like, and being able to rely more heavily on diversified sources of funding, which of course in a year when we have very high funding needs, is a step in the right direction, but I'm not sure it moves the needle in terms of the way in which you think about the supply-demand imbalance for the DMO, in part because it doesn't remove any of the barriers to entry that already exist for retail buying gilts. You still have to have a broker account, you still have to know what a gilt is and that the capital gains tax-free, and it's could be an attractive investment vehicle for some. And just being able to participate in auctions, doesn't remove any of those barriers to entry. And if anything, I would argue that actually is a more complicated investments or savings product for a retail investor. But also because part of the reason why we've seen a big pickup in retail demand for gilts is because of the capital gains tax-free advantage. So we've seen lots of retail buying of low coupon bonds and to take advantage of that tax initiative. But any new supply that's coming to the market, of course, is likely to be high coupon, and therefore for those retail investors that are looking to take advantage of the capital gains tax-free treatment of gilts, they don't offer that. Of course, the logical next question could be, what's next? Could the DMO issue some form of retail bond that's a bit more readily available, a bit more accessible, given that there's still a huge amount of cash sitting on bank balance sheets that they could tap into? To which I think the answer is probably it's quite unlikely in the near term. For a start, I think it's not necessarily any cheaper for the Treasury. When they issued that NS&I bond last year, the yield was 6% compared to a 10-year gilt currently, for example, which is only around 4%. Potentially risks being labelled a regressive policy as well, in the sense that if you're looking for, if you've maxed out all of your existing kind of tax-free savings vehicles and are looking for another way of efficiently managing money, you're probably in the very high percentage in terms of income and wealth distribution, and drawing households out of, or household cash, I should say, out of interest-bearing savings accounts also has tax implications if that cash is then put into tax-free vehicles. And finally, I think from a crowding out perspective, it also risks crowding out cash that would otherwise be put in bank deposits. But from a market's perspective, it has implications too, in the sense that I think both NS&I and retail bond issuance would likely be viewed as quite short-term funding sources, a bit like bills, so they could eventually need to be termed out anyway. And therefore, on the surface, although it kind of nominally solves or helps to solve the DMO supply-demand imbalance, it doesn't necessarily help to solve the duration mismatch, with nearly all of the kind of retail bond demand being very focused at the front end of the curve, and of course the DMO being committed to a certain extent issuing across the curve, although we expect small tweaks to that in the remit, as we discussed before. Anyway, that's probably enough on what was supposed to be a quiet week in the UK. So let's switch over to Europe, where it was a quiet week too, but we have had the PMIs and we have had the minutes from the ECB meeting last month. What's your takeaway from both of those, Joann?
So I actually think there were a couple of interesting things in the ECB minutes. I think one of the things that we really got was this confirmation that perhaps the ECB wasn't too happy with what the market was pricing in, at least for March. In January, which I think really spoke to that hawkish pushback we had before the meeting. And then perhaps after market pricing had adjusted, they were a bit more comfortable going into the meeting, which meant that we had a bit more of a dovish meeting than expected. And I think the minutes really did confirm that was the intention of the ECB to some extent, to push against the market pricing. And I think that's interesting to know in hindsight. The other thing that I thought was a key takeaway was in terms of how they're playing the balance of risks in terms of cutting rates early versus cutting rates late, because of course there's a risk that if you cut rates too late, that actually growth is impacted, and there's a risk that if you cut rates too early, that maybe the inflationary picture isn't easing as gradually you expected. So there's a risk that you have to hike again in the future. And it does seem like the way in which the minutes were written suggested that actually the risk that the ECB is more concerned about is that they cut too quickly. So whilst the data in our head might indicate that even by April that they could cut rates, and that actually the wage negotiation data starts to come out a bit earlier, like the not the final amount or the final number, but the individual negotiation starts to become more known and understood. We think even with those risks and with the idea that actually the data is moving in line with the idea that they could cut earlier, we think given that what they've said, they are more risk averse to cutting early versus cutting late. And to some extent, the easing in financial conditions as well has helped them along in that process so that they can leave rates higher for longer at this stage, and financial conditions have already loosened a little bit. I think the other thing was, of course, the PMIs, which was the key data for this week for the euro area. The euro area print in general was higher than expected, and that was really supported by the services sector. But I think what was also interesting to note was that there was a bit of a deviation, for example, in France and Germany's prints, where German manufacturing is really not doing very well, and where France we kind of saw a more broad-based improvement both in services and manufacturing. So I mean, German growth numbers as well were revised lower by the German government. So I think the picture for Germany's growth over this year really is not very pretty. But we do think that the PMIs, as in general, have shown a bit of a bottoming out. So really, the path for growth over this year should be one that is better than the last year.
And since we talked so much, or I talked so much about retail issuance, perhaps we can just quickly talk about the BTP Valore, the Italian Treasury's retail, I was about to say gilt, not gilt, retail BTP offering next week. Of course, the Italian Treasury, I think more than any other treasury in the euro area or amongst European governments, was able to tap in very successfully to retail demand last year. Do you expect a similar picture this year?
So we expect a fairly similar picture this year in terms of Italy being able to raise a very similar amount or even more from the retail side for this year. So I think going into next week, we've obviously seen BTP Valore over the last year where they've seen around 17 to 18 billion in issuance. So our base case going into next week would be that a similar number comes out of it. I mean, I think there's still a fairly large amount of cash available in household deposits for to really tap into this BTP Valore instrument, and of course there are tax savings in Italy from actually buying government debt. So that both of those things act as a positive. Of course, the yield that which it comes in will also matter. What's also interesting is that we're seeing some of these headlines around the EU potentially also having a retail issuance and a retail bond. It's fairly interesting because some of the pieces have suggested that maybe Italy is less supportive of this idea, given that that's in competition with their own BTP Valore, which is obviously very useful. But it's interesting to see that this question about retail demand is picking up even within the euro area as well.
It seems only sensible that everybody is kind of looking at alternative sources, or at least being able to diversify that funding base a little bit away from the market. Okay, all right, that's probably enough this week. Let's catch up next week. We can talk about the UK budget in a little bit more detail and anything else that crops up between now and then. Thank you for joining me. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.